Good evening, students. I'm going to start a series of lectures on financial accounting where I will try to cover from very basics of accounting and your suggestions in this regard will be highly appreciated. Here my primary goal is to develop your ability to understand and use accounting information in making economic decisions. To do this, you need to understand the nature of economic activities that accounting information describes, the assumptions and measurement techniques involved in developing accounting information, and the information that is most relevant for making various types of decision. So this is basically, we have a cycle that accounting links decision makers with economic activities and with the results of their decisions, like how economic activities flow into the accounting process. So the accounting process produces accounting information used by decision makers in making economic decisions, and making specific actions results in economic activities and that continuing the cycle. So the types of accounting information. So here we have three types of accounting information, and it's mentioned in the slides. That is the financial accounting, the management accounting, and the tax accounting. So just as there are many types of the economic decisions, there are also many types of accounting information. And the terms, as I said, financial accounting, management accounting, and tax accounting often are used in describing three types of accounting information that are widely used in the business community. So now the financial accounting, financial accounting refers to the information describing the financial resources, obligations, and activities of an economic entity, either an organization or an individual. Accountants use the term financial position to describe an entities, financial resources, and obligations at a point in time, and the term results of operations to describe its financial activities during that year. Financial accounting information is designed primarily to assist investors and creditors in deciding where to place their scarce investment resources, such as decisions are important to society because they determine which companies and industries will receive the financial resources necessary for growth. So, financial accounting information also is used by managers and in income tax returns. In fact, financial accounting information is used for so many different purposes that it often is called general purpose accounting information. On the other hand, we have the management accounting. So the management accounting involves the development and interpretation of accounting information intended specifically to assist management in operating the business. Managers use the information in setting the company's overall goals, evaluating the performance of the department and individuals, deciding whether to introduce a new line of products, and making virtually all types of managerial decisions. A company's managers and employees constantly need information to run and control daily business operations. For example, they need to know the amount of money in the company's bank account, the types, the quantities, and the dollar amounts of the merchandise in the company's warehouse, and the amounts owed to specific creditors. Much management accounting information is financial in nature, but is organized in a manner relating directly to the decision in hand. And the last one, that is the tax accounting. So here the preparation of income tax return is a specialized field within accounting to a great extent. Tax returns are based on financial accounting information. However, the information often is adjusted or recognized to conform with income tax reporting requirements. We introduced the idea of tax accounting information to contrast it with financial and management accounting information. Although tax information is important for a company's successful operations and is related to financial and management accounting information. It results from a different systems and complex with specialized legal requirements that relate to a company's responsibility to pay an appropriate amount of taxes. So now the basic functions of accounting system. So here we have a very simple thing. That is the first thing, that is interpret and record business transactions. So in developing information about the activities of business, every accounting system performs the following basic functions. So number one is interpret and record the effects of business transaction. So first we need to, find out that do the transactions are related to business, and do we have, these information should be recorded in the business or not? Is it related to the business? Then we have classify the effect, classify similar transactions into useful reports. So you can see that classify the effects of similar transactions in a manner that permits determination of the various totals and subtotals useful to management and used in the accounting reports. And the last one, you can see that it is summarize and communicate the information contained in the system of decision makers. So the difference in the accounting system arise primarily in the manner, frequency, in manner, frequency, and speed with which these functions are performed. So here it is a very simple idea. That is, usually if we are going to take the statement of a corporation, so there are basic forms of business organization like sole proprietor, partnership, and corporation. So in order to give you a basic understanding, we are taking here as corporation. So companies prepare their interim financial statements and annual financial statements. So if you were a person with a considerable wealth who wanted to invest in a forward-looking company in today's information age, how would you know whether Intel or any other company is a wise investment? What information would you seek out to help you decide where to place your investment? A primary source of financial information is the company's financial statements. And these statements, which are prepared at least once a year or in many cases more frequently, provide insight into the current financial status of the company and how successful the company has been in meeting its financial goals. So, in this lecture, you are introduced to three primary financial statements. The statement of the financial position, often referred to as a balance sheet, the income statement, and the statement of cash flow. So combined with the information presented in the notes and other accompanying presentation, these financial statements provide for investors, creditors, and other interested parties a wealth of useful information. So in the balance sheet, you can see that it describes where the enterprise stands at a specific date. This is a very important part, that the balance sheet is not for a designated period of time, like from 1st January till 31st of December, or from 1st June to 31st of July, or whatever it is, whatever the fiscal year of a company. It is a statement which gives you a specific date, the information of the company at a specific date, that what is its financial position or its financial stability at that particular period of time or at a particular date, like what are its total assets or what are its total liabilities, like immediate obligations to pay or the long-term obligations, and what is the firm's equity or the capital, whatever it is. So it is important to note that balance sheet describes where the enterprise stands at that specific date. Whereas if we are going to talk about the income statement, so it depicts the revenue and expenses for a designated period of time. It is different from the balance sheet, because in the income statement, we will take a designated period of time, like the income statement for 3 months, quarter, or for 6 months, semi-annual, or it is an annual or monthly or fortnightly or weekly or daily, whatever it is. But it must be for a designated period of time, that it starts from certain date and it ends at certain date. So how much revenue you have generated throughout that period, and how much expenses you have incurred, and what is the net income or net profit you have earned throughout that period. So we know that is in the income statement, it depicts the revenue and expenses for a designated period of time. And lastly, that is the cash flow, So what I was introducing you, that revenues result in a positive cash flow. So if you are going to sell certain things or goods and services, or you are rendering services, so for example, so you will generate the revenue and it will give you a positive cash flow. On the other hand, if you are incurring certain expenses in order to generate that revenue, so it will give you a negative cash flow. So the change in the positive cash flow and change in the negative cash flow, and the difference will become your profit. So either the revenue is generated in the past, present, or future. So we will discuss later on that how the matching principle and the realization principle will work on to recognize the revenue, and how we will match the expenses with respect to the period of time and the revenue when you are getting benefit to generate the revenue. Okay, so income statement is, finally, we have concluded that it is a net income or net loss is simply the difference between the revenue and expenses. Okay, and the last one, that is the statement of cash flow. It depicts the ways cash has changed during a designated period of time. So you know that when you generate the revenue, as I told you earlier, so it will increase or give you a positive cash flow, and if the expenses are incurred and paid, so cash will decrease. So there are different activities we use to address in the cash flow statement, like operating activities, investing activities, and financing activities, which we will discuss later on in the upcoming lectures. So cash flow, it depicts the ways how the cash is circulating in a company and how the cash is physically going out or coming in. So now, the concept of business entity. So, okay, so now let me summarize the entire thing, that the financial statement is simply a declaration of what is believed to be true about an enterprise, communicated in terms of monetary units such as dollars or any other currency. When accountants prepare financial statements, they are describing in financial terms certain attributes of enterprise that they believe fairly represent in financial activities. So in this video, in this lecture, we have introduced you the basic of these financial statements, as we discussed the statement of financial position, that is balance sheet, income statement, and statement.
Thanks for watching. For new video updates, press subscribe button so you will notified.